Hello and welcome to Pro Trader Strategies Market Commentary for Thursday, October the 27th. My name's Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, I'm here to teach you some different strategies that you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. A little bit of economic data across the pond. We had German preliminary GDP came in slightly higher than expected at 0.5%, was expected to be 0.3%. Here in the United States, we had core durable goods come in line with expectations at 0.2%. Unemployment claims came in slightly lower than expected at 258,000 versus expected 261,000. But the real number that really caused the overall market to get shaken up to the downside was the durable goods orders came in at negative 0.1%, was expected to be positive 0.1%. That number is pretty important because we've been seeing some of these other PMI numbers, the Purchasing Managers Index, come in a little bit better than expected. And one would expect that that was because durable goods orders were starting to ramp up. Having seen the durable goods orders come off a little bit, that's a little bit of a red flag, if you will, to those PMI numbers that they could be just ramping up in expectations of the holiday season, but not because they are starting to see demand ramp up. And then we had pending home sales come in better than expected at 1.5%. So that one was better. We saw some other pending home sales numbers, the existing home sales number come in lower than expected, but the pending home sales right now is what is under contract, if you will. So that coming in a little bit better than expected. Natural gas storages came in at a build of 73 billion versus the expected 71 billion cubic feet for natural gas. Anyway, on to crude oil. Crude oil trying to test that $50 a barrel psychological level that we talked about so much. It came down and tested that 61.8 Fibonacci level yesterday and repelled off of it. Today looked to test it early on, but has since really started to rally nicely for the bulls, up 78 cents on the day, but right there at that $50 a barrel psychological line in the sand. Gold right there in line with what we've talked about, just following along that 200-day moving average. It is up $3 on the day, trading at $1269.70. Gold really not having much of a reaction as the broader market is. Bonds were just down 2 points on the day, coming back just a little bit off of that, but a big sell-off in the bonds. 2-point move in the bonds is a pretty big move for the most part. We got below that 50 Fibonacci level yesterday, and the overall market has just sloughed away to the downside. Bears taking control of that market, despite the fact that the durable goods numbers was not that good. Dow Jones Industrial Average up 35 points on the day, right against that 50-day moving average. It'll be interesting to see if we can get above and settle above that. That would be a win for the bulls. On to the Nasdaq, slightly up on the day, up 2 points. Again, was up quite nicely earlier on this morning and has since given it back, testing that value area high and failing earlier on. The Emini SP is up 2 points on the day, again testing that 200-day moving average earlier on this morning, just about the time that the durable goods orders came out, and that's when we started falling away. This is where we were testing that 200-day moving average on the 15-minute chart of the E-mini S&Ps. And as you can see, we basically totally tumbled off probably close to, what is that, almost 20 points on the day on a sell-off from that durable goods orders. We are starting to see a little bit of profit taking and the market coming back right to unchanged for the most part. I haven't done a whole lot today because we have a lot of earnings and some of the big boys coming out later on today, so I'm saving some margin for that. We've got Amazon, Google, Amex. Twitter was supposed to come out this afternoon. They changed it to release this morning. And we also have Texas Instruments coming out, or I believe it's Texas Instruments coming out tomorrow. So keep your eyes out for that. So follow me on Twitter at Wolfman's blog. I'll be tweeting out what different earnings trades I do. Also, tomorrow we're doing a webinar on the short straddle. So check that out. I'm going to go through all my rules around that and how to build that out to increase your probability of profit. It might seem very easy and intuitive to be able to sell a straddle right there at the money you're selling the same strike, but I have some rules to go around that to increase the likelihood of being profitable on that trade, because it is a difficult one to be profitable on because you need a really sideways moving market. But I will show you how to build that out like we did on the floor and increase your probabilities of profit. All right, that's all I got for you guys today. Hope to see you there tomorrow, and if you can't take that, take it easy.